in the dark day. This goes without saying. Violence is never the answer and should never be tolerated. And yeah, your heart just goes out to those impacted who are having to live with this. Both the September 11th, which resonates through families for their entire history, rest of their lives. But it's going to be the same thing for this family, Charlie Kirk's wife and kids who are left behind. So it's just really sad to see. Um, and I think we're at a cycle in history where, unfortunately, this is something that's not going to go away, in my opinion. So I mentioned here the violence cycle, not to stir up, just clickbaits, the typical media. If it bleeds, it leads. This is, I want to talk about it in a way that, like, from the zoom out perspective of understanding what's going on from history, how do these things move? How do you place what happened yesterday, which seems as such a random, senseless event, intolerable event. Um, how do you actually make sense of this and your own worldview, how to understand what's going on, but also how this impacts financial markets, because financial markets actually kind of reflect this big picture, broad violence that's escalating in a ladder essentially through society. And I think these things are connected, despite, and maybe I am grasping at straws, to what's the saying, to the man with a hammer, everything looks like a nail. But I
Yeah.
think if you look back on history, when you see this kind of social upheaval, old ways are making way for the new, and we may be at a bigger cyclical wave in terms of the longer term. If we think about World War One, World War Two as being so massive, such catastrophic kind of violence, just spreading throughout world society, so much death, early death, essentially, male populations taking the brunt of that. Um, you hope that the violence will stay, we'll keep a lid on it. But yesterday's actions, kind of like how you immediately feel about them, how they hit your emotions in the immediate aftermath. It's a time to pause and reflect, but at some level, there's nothing one individual can do to stop the momentum that's already underway. What do I mean by that? Um, Once you get onto these escalatory ladders, right? And at the end of the day, just remember all of these events are arising from human action. There was a shooter yesterday, carefully planned, it would seem. The fact that there's, what stands out to me as everybody's trying to understand this and what went on, the fact that in a massive crowd, public event, a shooter is able to do what he or she did and commit such a heinous act and cowardly act, but get away without being caught or spotted, that's a sign of sophistication in my read of the situation. And I'm not in law enforcement, not a detective, et cetera. But just the fact that we haven't found this person yet is suggestion of planning. If you all remember prior episodes of violence, if you remember the Boston Marathon, right, that was not to all looks a professional. If you remember, it just ended up to be like two reclusive, what would you call them, just kind of pariah type brothers who did this, and it was really, really one of them who was pulling the strings, it seemed, and influencing the other. And it took multiple days, if everybody recalls. They eventually found the person. He rolled up in a hideout into like somebody's just boat sitting in a neighborhood, and that was kind of his last stand. But yeah, so the fact that you can, commit such an act and flee the scene, it's hard to do. Doesn't have to be a professional though, as we've seen in history. But that was with just a pressure cooker bomb that was left on the street. You have time to walk away and get distance, and then plot an escape or escape detection for a shot to commit this with firearms. you're at the scene pulling the trigger. You don't have that distance between yourself and a weapon, to flee the radius. You have to avoid detection somehow. And, most people, if you just pull them off the street, they're not going to be able to do that and get away with it. So it does, to my mind, there was planning behind this. All of these things are human action. Remember, if we even look at September 11th, right, took a lot of planning to get there. And this is where, people in financial markets, or just to describe human events, we have come up with this term in the last like 20 years with the popularity of Nicholas Taleb's framework of black swans, right? Like they're just things that happen. No one could have seen these coming. They come out of nowhere. But at the end of the day, I try to, you know, um, think about these things in terms of they are human action, in the old Austrian school framework, right? What is the difference between an Austrian economist and your technocratic Keynesian economist, right? Who's kind of prevailed over the last 100 years? I think the technocrat would say we can boil this down to numbers. They're just, random data series, random walk. These are just things that happen. They show up in your data set. And hey, every once in a while, you just have a Six Sigma or 10 Sigma event these things just happen, right? Versus the Austrian approach. It's like humans plan to bring about outcomes or ends. And that's the key to understanding economics. And that really is um, the crux as I kind of examine these things and try to understand how both camps of thought work. That is one of the crucial differences between these two things. So as you look at what's happening with the violence, I think the easiest reaction is just take a knee-jerk response. And that's what sadly just see in the media today. The left takes it one way, the right takes it the other. There's a human element to this as well. Someone had a point to do this. Now we don't want to go too deep into who, what, motive, etc. But at the end of the day, the action's done. We have to live with the repercussions. And now you're looking at outcomes. So it's fairly obvious at this point that there's a divide that's growing in American society, also globally. It's part of this big transition of these old systems um, coming into disruption and working towards some new steady state. But that process is going to be extremely messy. I think trying to understand yesterday's event in that terms will kind of give you predictive power of what's happening. And I labeled this section the violence cycle. At some point, there's an escalatory ladder, and you wonder who is in control, right, towards taking this thing to its next step, right? And you look at prior events, eventually you get to things like catalysts, as we talked about with France last week and what's going on with their no confidence vote situation. That's going to lead to a next action, right? This event is going to lead to a next action. I think the immediate response is there's no way to avoid it. This is going to trigger an emotional response in the right, the camp where they just took a heavy loss, right? They're emotional. They're dealing with the sadness. Go through the 5 stages of grief. One of those is anger, right? So there will be a response to this, despite uh, any and all efforts to try to put a lid on the violence. This is just, I think, in my mind, part of that process. And in the worst case, you see this escalating. We don't know where that end outcome is, but yeah, I think it's a very sad day and scary day for where things are headed. And I think from a financial market standpoint, it is related. I don't know how much we can talk about that or get into it, but it goes into the planning as people. Same thing on the human action, taking these actions, causing these events. Humans will plan for that in their savings decisions as they're, trying to find safety in terms of where this thing is going. So we'll get into that in number 2 and number 3 with the Treasury auctions and the S&P 500 leadership deep dive. But maybe it will shed some light on things, make some sense, hopefully, bring some clarity to things that in the immediate aftermath just make no sense.
Yeah, and I think it was important to touch on this because Matt does a really good job every single week trying to find what those top three or those big three items for the week are, and this clearly will be or is already a big point that'll change American politics. Kind of moving forward, we'll see where this goes. So with that, let's pivot a little bit. We're going to start talking more about market specifically, but again, something to be watching. There's a trend going
Yep.
on here in the U.S.
It My argument, it's not I don't think this is a reversal or a turning point. A reversal would be everybody, says this has gone too far. Let's put our weapons away. Let's open dialogue, come to some sort of agreement on how we can all live together. I don't think it's that. I think it's a turning point in terms of escalation on the path we were already on, unfortunately.
Yep.
So time will tell. I hope I'm very, very wrong on that, but that is my base case. Yeah. So let's get into Treasury
Yep.
auctions.
I agree with you there. All right. Well, flipping over here, Matt, why don't you go ahead and explain, what this chart is and, what am I looking at?
Yep. All right. Zoom out. Maybe shut the chart off really quick, Cameron, so I can give some background. So this week, in financial markets, key amongst them, U.S. Treasury bonds. Um, we had three big auctions, right? And these are the coupon auctions that take place once a month. On top of that, not just once a month, the coupon auctions are issued in terms of there's one bond for each maturity, and there's multiple auctions held for over a quarter, so 3 months, one, two, three. Call the first one the primary auction or the opening, and then those second 2 months, the follow-ons are the reopening auctions, where it's not technically a new bond that's raised, it's an auction that's held to top off and basically add a debt raise on top of an existing bond. So this month we had the 3 year, 10 year, and 30. Or I say this month, sorry, this week. So Tuesday, Wednesday, and Thursday today. We went and did the 3 year, 10 year, 30 year in succession. And how those goes tends to be very informative for just interest rate movements as a good temperature check for where you are and then where things may be headed. So in those auctions, there's basically they divide it into three parties: direct, indirect, and then primary dealer. Let's just take it as let's group direct and indirect together. Let's not talk about those. And so dealers and everybody else, right? Dealer demand tends to be special because it's kind of your slack purchaser of treasuries at this auction. If there isn't a demand from the rest of the market, dealers come in with the back bid, if you will, the backstop. And if you see heavy dealer takedown in an auction, it generally means there was too much treasury supply relative to demand for that borrowing. So demand for money outpaced supply. What does that generally correspond to? Lower clearing prices, right? Or equivalently higher
Higher yields.
yields.
Yep.
So when you see dealers having to step in and take more auction size, that'll tell you one thing versus there's a lot of demand from everybody else. It tells you there's a large supply of money that's looking to find a home to park in. And then on the demand for borrowing side, from the Treasury as the borrower in this case, there's not enough. So in that case, what do you expect to see? Yields down, right? And that's really what we saw this week. So we saw across all the 10 year, the 3 year, and the 30 year, the dealer takedown or the percentage of the auction that they were stuck with after the result came in was at all-time lows, for all three time series. And this is a trend that's been moving down and to the right since the global financial crisis. Dealers have been taking less of the coupon auctions, right, over time, like just moving cyclically down and to the right, which means the rest of the auction, the rest of the market is actually coming in. What is the rest of the markets? Banks, insurance companies, pensions, and they can be onshore based in the US, domiciled US kind of sponsored companies, or they can be offshore to international companies who come through. Usually they come through the Federal Reserve Bank in New York as like their custodian, their agent, all that stuff, and then they come through the auction that way. But I think the key here, what did we see this week? the like an all-time low on dealer participation from on the 10-year auction, and then the 3-year and the 30-year followed suit. That's these kind of yellow arrows I plotted. So on the bottom, I mark, when that 10-year dealer participation hits a cyclical low. And then on the top, I kind of benchmark it and want to anchor it to what's happening with the level of interest rates. So for the red line, I chose a future on a treasury bond. You can pick, there's 2-year, 3-year, 5-year, 10-year, 30-year. And to get this to line up and show the volatility, because the more duration you add to a bond, the more volatile the series will be in terms of swings from high to low on price. And if you go too much on the 2-year, then you're getting influenced by expectations on the money market, because money market is basically 1 year maturities and the 2-year bond is really it's basically half money market expectations,
Right.
half level of the curve expectations, if you want to roughly split the impact. So 2 years is probably not a good proxy because you'll be swung by the money market swings, which is really the tail wagging the dog of the entire system. Won't get into that here. But I just picked the 5, right? It's a little lower duration, you get lower volatility. It's not one of these auctions we map, but the level is going to rise and fall together. So it's going to tell you the level of the Treasury yield curve. And I think generally what you see, and if you think about this, and I'll explain the mechanism why it might make sense, but when dealer takedown is low, right, that means everybody else in the market is coming in. They want to buy. There's demand for treasuries. So that tends to occur when yields are low on the cycle, right? Doesn't mean at all-time lows, ZERP, whatever. It just means, like, look at the chart, highs and higher highs, lower lows. They tend to correspond. So, and you can see this, I'm talking about just the swings on the chart. So maybe think about this as like secondary trend, which is riding the primary, big picture wave that the money markets are really responding to. So if you look at it, when dealer takedown hits a low, what does that mean? Dealers aren't stuck with much inventory, so they don't have to buy at low prices and sell high. Think about Costco or any other retailer, right? What's your business? Amazon. You buy goods at a low price from the supplier, right? Probably some manufacturer in China, offshore, et cetera, for those two retailers. And then you sell it into the market, U.S. Consumer demand at a higher price. You make that spread. And if you're Costco, that's your business, right? Amazon, that's one of your really 2 or 3 big businesses. You can put cloud in there, but that's how they make money. You kind of take the same approach. Think about treasury bonds in that way. The supplier is the government, right? They're producing bonds, right? Because of their demand to borrow money. The dealer or warehouser in the middle here, Costco, Amazon, they're the primary dealers, right? So you're 16 to 20, approved primary dealers. It's all the large banks, a couple of other investment banks who commit to, supporting that treasury business. Those are your Costco's, the man in the middle operating in that business. And then your demand side is, like the equivalent of your U.S. consumer for Costco. That's your U.S. household consumer in that framework. In the treasury bond market, the demand is coming from balance sheets who have demand to deploy money, like savings, into IOUs. So banks, insurance codes, pensions, et cetera. Is that jiving, Cameron?
Absolutely. Yep.
Everything making sense? All right. So when we see dealer takedown high, as if you remember back in May, we had some bad auctions on the 20-year,
Yeah.
right? And you call it a tail, right? The auction comes in a few bips above what the market expected the auction to clear at in terms of yield going in. That's called a tail. The opposite of that is when demand for treasury bonds outpaces supply and yields actually come in inside of where the market expected the auction to clear going in, which is called trading through, right? The yield actually comes in lower than expected. We saw that pretty much across the board. So the 3-year and 10-year came in through this week, and then the 30-year was this morning was basically, you'd say, right on the screws. It cleared. So not much of a tail, not much through. It went well. And also, if you're following the chart on yields, yields are low relatively since the Trump administration entered office and Treasury Secretary Scott Bessent came in. You've got a very clear trend in the 10-year, which proxy is the level of interest rates on the curve itself, lower highs and lower lows, right? So U.S. yields have trended down. It's kind of one of the standout cases this year, and relative to other sovereign debt markets, Europe in particular. It looks like that trend is the opposite direction. Yields want to move higher. My point here, with what we saw with the primary dealer takedown, the dealers aren't left stuck with inventory that they need to find distribution and sell at market, or sell into a market. So what does that generally mean? It means the customers already showed up and got filled up with their inventory. Dealers didn't have to come in, backstop the auction, buy the inventory cheap at a concession, and then their business is to sell it out, like put it up, find homes on balance sheets, to take their inventory. Generally, when that happens, when the dealer takedown is high, yields will correlated, right? They tend to be higher. And then over the coming months, as the dealers need to free up that balance sheet capacity, what you'll generally see happen is yields come in, right? The other scenario, when dealer takedown is low, the rest of the market came in, flooding capacity, excess supply of dollars, in terms of savings that need to find a home, not enough demand for financing for that supply of savings to go find. Yields come in. Generally, what that may be a sign of, if past is prologue, when we see that, if you look at the chart, the white is the 3-month moving average of dealer takedown. The red, I've got the 5-year future bond price. So red line when it's high in terms of the cycle, what that's corresponding to is yields low. And then as that number moves down on the red line, that means bond prices are falling, or at least the futures price for those bond prices are falling, which is corresponding to yields turning up on the cycle. So if you look at that kind of past as prologue, right, you generally see when dealer takedown is low, yields tend to flatten out, or I'd say correlation, those bond prices tend to come off or fall as that excess supply of savings tends to get deployed, finds its home, and treasuries, a level of yield curve, then kind of mean reverts to some level what it was over the short term. So it's kind of a sign of yields kind of stabilizing and starting to come back a little bit after they've rallied very aggressively here over the last 1.5 weeks, ever since we've been in September. But broadly speaking, yields have been in an uptrend all of 2025. So maybe in terms of the next market wave, a little bit of retracement before we get back onto that cyclical bull market is what I would expect. Any questions there?
I was going to ask, so you mentioned, kind of seeing that downward trend in your mind. How much of this kind of relates to today's CPI print, for example? I know this is historical, but you've got rate cut expectations. You see CPI coming in a little bit cooler than people expected. Maybe PPI didn't kind of lead into some of those price inflation numbers. So I'm just kind of curious, how much of that can you kind of associate with this versus other things that Treasury Secretary Bessent is working on.
Yeah, so we didn't put a slide up for the CPI, but you mentioned cooler. I think it's cooler relative to expectations, or maybe could it be very bad, right? But if you look at the numbers, right, the core CPI came in at month over month 34.6 basis points of increase.
Yep.
And then all items CPI came in at 38.2 basis points of increase. If you annualize those, that's a CPI, that's an uptick, right? It's very clear if you look back on the chart, like ever since the bottoming in May, we're trending up in terms of price inflation. Now, the response to that uptrend, right? And this is confirmation that price levels are increasing, right? But it comes down to market response. And last week we talked about Gordon Pepper, money, credit, and asset prices. Look at the response to positive news, or sorry, to negative news. So remember in 2022 when we started seeing the CPI, or 2021 is really when it started
Wrap it up.
to creep up. And then we didn't know at that point where it was going to top, ultimately in May, June 2022. But at the beginning of that process, the market response to the news, which is the CPI print, as they were coming in hot, the market response was sell-off, and that sell-off was cascading. It got more and more aggressive the more that news came, and the result of that feedback loop was um, a bond market response to what was happening with consumer prices in the economy, where essentially you had to break Fed, QE, and ZIRP policy, right? It was strong enough to do that because of the cascading loops, right? Why would that be aligned, right? It's like, well, the news trend, what's going on in the real economy in terms of pricing on goods and services, was pointing in the same direction as the that imbalance between the supply and demand for money that we've been talking about for the last week and a half on our review. When those two things, like this, the differential, right, between supply and demand, that will contribute to your over or under reaction and the financial markets response to the news. So, for example, today's news, which, all right, inflation ticking up, that's not a good sign for bonds, right? If this impulse keeps going, eventually it's going to hit the purchasing power of bonds. And the economic response is, hey, yields need to be higher to compensate investors, to make them whole essentially for the loss of purchasing power on their savings in those dollar IOUs. But we saw today the response to that uptick in CPI, which confirms the trend. Like the data point is confirming the trend, at least in the short term response, that we're in an impulse of CPI increasing. Bonds have actually rallied slightly, right? So it's telling you the reaction, like that supply demand imbalance, that excess supply of savings going after a smaller amount of demand for money, which is creating those IOUs for savings to invest in. That gap is still so large that it's showing up in the response. So that bad news is actually treated with not even a sell-off. It's not overreacting. It's
They
like,
need a place to park
uh,
it.
yeah, it's like you can have a roommate who is either hypo or hypermanic, right? And let's say you do something, it's like I don't know, you leave something out that shouldn't be away, or dishes aren't done. Does that roommate just blow off the handle at you, like escalate all the way into like some sort of argument? That would be like a hyper response. If the imbalance were the other direction, and say the Treasury were trying to tap, there was too much demand for raising money from the Treasury or the rest of the issuers and the debt markets versus a shortage of supply. If we had been in that scenario today, you'd see a different response, right? But the fact that on bad news, you're seeing a muted response, and it's not even a sell-off in response to the CPI, it's actually just a lower rally, right? Versus what we saw like since September 1, we got back in our chairs as portfolio managers since Labor Day. Yields have been coming in aggressively, right? If you look at the chart, both like treasuries, the yield curve, but also like LQD ETF for investment grade corporate bonds. They're rallying very strongly. And in today's response, it's like, well, the rally is just very soft, right? So that's telling you that underlying dynamic in the supply and demand for money That imbalance it's there, and it's responding, or it's the market response to the news is what kind of tells you what's going on, or the conditions of things. Is the roommate with you hypo or hypermanic? And the hypo case is, hey, you leave something out. Your roommate just doesn't care. He goes in his room, shuts the door, goes and studies by himself, or does whatever. He's not going to confront you. That's kind of the case we're in today. It's not a violent response. It's just whatever. Keep bidding. Keep bidding the yields in. They're going to come in.
Yep. Something to keep watching for sure as well. I know we've been mentioning this across multiple episodes as well, but you're seeing it continue. All right, so let's go here. We maybe I'm gonna flip back to just you and I for a second. So, just to set this up a little bit, you mentioned S&P 500. Matt put together kind of a listing of top 25 tickers, and I want Matt to maybe explain first what we're gonna get into before I just blast it up on the screen for everybody to start reading through.
Yep. Top 20. So I wanted to do a deep dive on the S&P 500, just to get a sense of where's leadership coming from this year. That will also be informative of kind of the underlying dynamics of what's actually taking place, and not just the index itself, or company valuations, but what's going on in the actual real economy, what's actually driving growth, um, what the heck's happening, right? We already talked about in the first session, like the escalatory ladder of violence, right? We know it's pretty clear what's going on in society, what's going on with the investment of capital, human action, all of that stuff in terms of how people are actually deploying society's savings imbalance right now, which appears to be positive. What projects are those actually going into? And that will actually tell you the underlying dynamics of what's going on. Now, I've heard from people, and same way you have the moniker with the news, if it bleeds, it leads. I think it's the same thing. You're tapping into the same amygdala hijacking, in our brains with doom scrolling, right? With markets, it's always a sense of like this thing is screwed, right? There's always a crash right around the corner. And, maybe there are always going to be corrections and pullbacks on markets. Those are unavoidable. But, there's a lot of worry right now that everything's just, one day, 1 week, one event away from complete collapse. Markets are going to go to hell in a handbasket. This is 2001 all over again, or 2008, or March 2020. Got to try to understand that doesn't necessarily have to be the case from a monetary or a fundamentals perspective for equity prices. So I wanted to go in and just take a deep dive. What's actually going on? What are professionals actually bidding up and telling us where the value actually is that's driving results? And I think for the dominant kind of mindset that most kind of financial advisors and institutional investors operate under, 60/40, or adjust accordingly, right? Dial it up, dial it down. Just passive equity, passive fixed income risk. Choose your risk tolerance, and that's how you line it up. That doesn't actually give you much in terms of analysis on diving deep under the hood and understanding what's actually going on in the real economy. So I wanted to do that, and that can give you some confidence or conviction and where things are headed, so that you don't get shaken out on the squiggles on the line, and you don't be a buy high, sell low investor, as kind of the street wants you to be, to keep the engine, to keep their money engine humming along. Have some conviction, understand what the valuable things are that you actually want to own for the long run, that are in line with the core underlying trends of where the real and financial economy are moving. So with that note, dive deep. What are for 2025 year to date? We've got 9 months, or almost 9 months on the books now. Starting to see some separation, very obvious signs of winners and losers. So these are the top 25 performers in terms of S&P 500 return year to date. I think the first highlight I would call out. There's only one Mag 7 name on this list, and that's number 15, Avago or AVGO, Broadcom Inc. I double check the list of the Mag 7, but I don't know if they're actually included. They might be the number 7. It's typically what Amazon, Google, Apple, Tesla, Nvidia, Microsoft. Am I missing one? Is Broadcom the 7th?
Yeah, I don't think Broadcom even shows up on the Mag 7.
Okay, so check that. We'll check that in show notes, right? Broadcom may be one of those market leaders from 2023, 2024. Other than that, you don't see any of those other FANG names on the top performers list. Yet you see an S&P 500 that's up 10 to 15% year to date, an aggressive rally from late April continuing into present. What that's telling me, we're seeing this is dispersion, right? But it's not necessarily dispersion through every asset class, right? So if you look at the leaders, I tagged the who's who by sector, you start to see the very clear trends, right? And so if you look at, all right, number 1 and number 4 top performers in the index year to date, Seagate Technology and Western Digital Corp. What do? They make storage, right? Hard drives for data storage. This is on theme with, this AI trend that we've been talking, or that's been driving market results, essentially the bull market in equities since 2023. So it's part of that theme. And I think maybe we don't have the right word, is going to be my takeaway after this to describe this wave that's pushing equity markets forward. I'll get into that in a second. When we think AI, you tend to just think of the GPT model companies, command line based interfaces, ChatGPT, Grok, Perplexity, etc. My point here as we go through this list, it's going to become extremely hard to refute this evidence now that it's laid out. But this is a much bigger underlying trend. It's an entire kind of industry landscape, if you will, or economic landscape. I think that's shaping up. And I think that'll lead some conclusions that there's actually something much bigger going on. And this probably isn't a 2001 or 2008 or 2020 type of situation where we're building up, we're deploying society's savings into investment that's not leading to any economic results at the end of the day. So point there, we covered Seagate and Western Digital. That's the data storage, right? Cameron, you can talk about data pipelines, right?
Yep.
To run and train the data models, what do you need? You need hard drive space. So you're slurping up data from sensors. We'll talk about those in a second. Just making massive data sets. You have the compute layer, which will be the GPUs and where the data kind of processing takes place. But the storage, that's the resting point of where the inputs and outputs finally go. You see the top 2 of the top 4 performers in the S&P 500 are data storage. That's telling you the demand is very strong from this underlying trend that's driving economic growth. The strong signal in that is my argument. Any comments there, Cameron, before we go to the next one?
I would just add too that the storage pieces, if you dig into what Seagate and Western Digital are actually building right now, it's very interesting, but it is very technical, right? It's things that are all about increasing bandwidth and increasing throughput. And if you think about it, if you need to run these inference models, things like that, you need to find ways to move. You see these models, they say trained on petabytes of data. You got to be able to run that data through the pipes that as fast as possible, which also means you got to pull them off storage as fast as possible. So there's some interesting things going on in that storage space for sure.
Yep. All right. And then, yeah, as you mentioned, throughput, I think that's just a natural. I'll skip going down the list and make sure we cover everybody, Cameron. But number 14, Corning Inc., probably the largest maker of fiber optic cable, right, for that data transmission.
Yep.
Photonic components for telecommunications. They manufacture glass panels, so the things for your iPad screens or iPhone screens. That's what really carried the equity or the business in the 2010s as that adoption of mobile as kind of the input or the edge of this big system, right? Of I don't know what you call it, just data, right? Information, right? Hit the endpoints. Like we put iPhones in everybody's pockets. Well, to make the glass screens, shatter resistant, the Gorilla Glass, all of that. That drove Corning equity higher in the 2010s. But for this wave, right, what's going on with the data processing, like essentially a completely new generation of information technology, right? Well, it's fiber optics, right, or that throughput where that is really driving the business from a revenue standpoint, right? Um, I don't know, Cameron, do you know more about Corning or anything deeper there to add?
Not specifically, you touched on kind of what I
Okay.
would touch on, but I do want to note I just looked it up. Broadcom confirmed is in Mag 7, so
It is one of the,
yep.
that's what I thought. I thought they were like the number seven. They've been an addition since they've been performing so strongly in
I always just don't think about them
23,
in that
24, and
default Mag
2025.
7, but yep,
Yeah.
you're right.
Yep. They are considered one of the behemoths at this point. But they're the only one of the seven in the list. The next one I mentioned, number five, Oracle AI and data processing, I call them. They're really and you can talk about Oracle as a very kind of complicated or complex business. They have their hand in a lot of different kind of sectors of information technology. Number one above of that would be their data warehousing, right? The Oracle databases, right? Data warehouses, large solutions for corporate clients, right? But on top of that, they're just doing a ton of work with the companies who are ultimately like building these models, right? So they're a key supplier into this AI and data processing trend. Anything there, Cameron? And they had a massive earnings number this week. Stock was up 34%. Um, the headlines will say, "Hey, Larry Ellison's now the richest man in the world." It's like we're missing the forest for the trees if we just focus on those catchy headlines, just tracking individuals and their celebrity, not really appreciating what that value signaling what the market is telling you with its value signaling on what's actually happening in
Yep.
the real economy. Yeah.
I think it's just a further comment on, if you look at each of these individually, you might say, okay, well, Seagate, I bought a hard drive for my computer, not a big deal. Oracle, well, I don't know, I use MySQL database or Postgres, right, or whatever it might be. But if you really dig into it, what is this? This is corporate level. This is I need to go build data centers across the country. I'm going to contract with Oracle to design and develop all of these, right? I'm going to contract with Seagate to go build 100,000 SSDs to deliver in the next month, right? Whatever it might be. So these are really, if you see the names, you might initially think, well, these are just household, generic
Yep.
tech companies, but these are all specifically in that big space of designing out full, end-to-end data center projects.
Yep. All right. I think the next one I'd mention, the next kind of grouping, number eight, Amphenol, number 20, Jabil, and number 23, TE Connectivity. I would catalog these as sensors, right? And so if you think about what do you need for all this AI, you need a bunch of data, right? Well, the sensors are that, right? They're non-human input derived data sources. So capturing data anywhere and everywhere could be natural processes, weather, etc. Um, could be manufacturing processes, right? I mean, just the demand for sensors is just very strong and robust. And it's, if you think about inputs, right, to this entire kind of new industrial revolution, I guess. I don't know if you want to call it that term. It's very WEF, World Economic Forum terminology. But the inputs to this new economy are, first and foremost is data, right? So the sensors are key to that. Talked about the other core goods, right? You need a data center, you need um, GPUs. You need some human capital who knows what they're doing in this space, all of that. But at the end of the day, data. If you don't have data,
Yep.
there's no model training. So yeah, those sensors, the performance, they're part of this ecosystem. The next one I go number 11, Micron, right? So there's kind of a trend I'm hearing to the experts, and I'm definitely not one of them. This is something I'm striving to know more about. My focus is fixed income markets, and uh, and then my passion and hobby is Bitcoin as well, and I blend those two. But understanding data and all these ecosystems deeper, something we're striving on doing. I know Cameron, your expertise is much better than mine already. But in terms of what's going on with memory right now, what I've heard some industry analysts say is particularly interesting here. Basically, they're saying there may be a way to essentially run not the training layer, right? The training layer is very GPU intensive still, but the model recall or inference steps where you're actually asking the model to do things like how we interface with a command line tool like ChatGPT, for example. A lot of that can actually be run sufficiently in memory, right? So on the edge of the device, that's a trend that's happening. So Micron performance, number 11, they tend to be very cyclical, right? Demand for memory. But they may be riding kind of a bull wave within this wave as well, as more of that demand shifts over from GPUs towards memory for processing instead of centralized are taking place at the centralized data center, which is very CapEx intensive. Um, for all the inputs that go into that, real estate, GPUs, energy, et cetera. If you do it on memory, well, you push that to the node or to the outer edge of the system with the ultimate endpoint, whether it's a person in their role in their job as a business, running these models on their local devices, or an individual calling ChatGPT, talking to it on their phone, all that stuff. That is definitely a social trend as well. People becoming friends with their chatbots, as kind of the movie Her predicted back in early 2010s. If anybody's seen that or remember that Joaquin Phoenix movie, that seems to be like something that's going on as well here.
And I'd add to,
Um,
again, it's the data center build out, right? So you still need some base level of general compute that's not a GPU to be able to run the actual, usually it's a hyper specific, hyper proprietary type of distribution or something, but you still need RAM for that, right? So there's on top of the, growing need or want on consumer endpoints for higher amounts of RAM. You are also seeing that for the actual data center space. So Matt's absolutely right. Even here at my house, you can run local models. I encourage anybody to try it, but you'll find quickly that you need a lot of RAM to do it. So it's just another piece of the puzzle there.
Yep. All right. I think the last one on this we haven't touched in the AI data or information technology space in this big new wave. Number 21 and 22, the fabless chip design production companies, Lam Research Corp and KLA Corp. Um, Basically these firms don't have the high capex of developing the chip fabrication or semiconductor fabrication facilities, which are massive costs. They're some of the largest capex projects that humanity's ever undertaken. We pretty much send all of that business to TSM, right? Taiwan Semiconductor. So you're ultra smart people here from Lam Research, KLA Corp, those types of companies. They'll design the thing and then they'll ship those plans, those directions, if you will, um, to like a TSM. They'll actually produce the good. But yeah, number 2021 and 2022, your semiconductor design shops continue to show that strong performance that they have over kind of this entire bull cycle. So you can kind of see in the blue, this is, in my opinion, this AI information processing, all of this is they are driving like in aggregate your performance of the equity market. So if you're a financial advisor and you tell your client, hey, our plan is 60/40, under the hood, this is what you're betting on is this thing. This is what's driving you your whatever your expected return number is, 8, 10%, 12%, whatever you're expecting to get from equity. This is the growth, right? The lines highlighted in blue. And I think the key thing this year, it's not just your Mag 7, like your hyperscalers where the capital is flowing and the returns are. it's spreading into more companies who are providing picks and shovels and contributing to this overall industry. And at the end of the day, like this is where the economy appears to be headed. Now, does it work? Yes or no? That's what we're going to find out. But this trend, if everybody's worried about a 2001 or a 2008, we're getting frothy or everything's too concentrated in one name. Microsoft and NVIDIA add the largest, two companies in the index, et cetera. Everything else tied to this is actually coming along and kind of trailing in their wake. So you're seeing dispersion take place. The other ones we haven't talked about, if you look at yellow, those are the energy companies. Energy is also a key input to this. So depends on if your energy or your utility is in the right spot and with geographic location where the data center build out is taking place. Then also type matters, right? If you're wind or coal, right, not doing so great in 2025, but if your other sources of energy, you're seeing that bull market pull from the demand side show up in equity prices. And that's number six, GE Vernova, which is the energy spinoff of the GE, corporate restructuring. Number seven, NRG. Number 17, Vistra. And number 25, Constellation Energy. So being in the right market, having the right types of energy supply, those are key for equity performance. But they're riding on this big trend that the blue highlights. Those companies, they're piggybacking on that same trend. Then the other ones, just before I get into the key one that I want to get to, what's not there, logistics companies. So Uber at number 16, DoorDash at number 19, and eBay at number 24. If you think about it, all that these companies are is tech companies that are just attached to the movement of goods, like real physical goods in the economy. So for Uber, it's either people or food for the most part. DoorDash, it's food. And then eBay, it's just secondary market transactions like of new or used goods that are shipped through the mail, like US Postal Service, UPS, or FedEx, who noticeably are not on this list. But what would you just call it? Like the digital design of logistics. Those three in purple are actually like by those pulling up. Um, that's in my read on this, the fact that the market's saying there's value there, the real movement of goods is actually tied to that big trend of like the movement and processing of information that is really everything in the blue lines, right? But at the end of the day, everything we're doing with AI is just gather a bunch of information, and instead of having your 20-year-old young analysts, crank through this in Excel, we're getting better and better at processing this so that, yeah, we'll still hire some of those 20-year-olds, or employ some of those 20-year-olds in that task of taking information from raw into higher value forms. Now we've got tools and infrastructure to do that much cheaper, but also in infinitely larger quantities. And then your purples are kind of where the real world kind of rubber meets the road in terms of things or the physical elements kind of moving to where they need to be in that whole design. So that's how I'd read that strong performance this year from Uber, DoorDash, and eBay. Um, well, I think the dog not barking here. Why is Amazon not moving? So that's something Cameron, myself, came from Amazon. I think that's an interesting one is Amazon's performance lately. It's fine, but it's a bit of a laggard. That's something I would call out as a deeper dive. And I know back in the Amazon days, if we were seeing this type of result, measuring ourselves versus competitors, which is what Amazon consistently does. They don't focus on competition; they focus on the customer. But you constantly benchmark yourself against competitors. We would have had a deep dive on this from our executive leadership down to our roles where we were sitting in the company in our 20s, right back in the day. So we're looking at you, Amazon. Watch that one closely, and we'll see what happens there. Maybe we'll talk about them in more depth on a future weekly roundup. But then I want to get into what's the dog not barking here, right? And I think there's One of these things on the list is not like the other. That's how I think we'll close out the show. And that's performer number three, Newmont Corp, right? Newmont is a gold miner. They're the only gold miner in the S&P 500, right? Number three, up almost 110% year to date. And if you look under the hood, we'll go to the next slide, Cameron. I mean, everybody's aware with what's happening in gold price, right? Started, in 2024, breaking really decisively breaking out of that $2,000 level, price of gold per ounce. That really it kind of sat there from August 2020 up until I would say late 2023, early 2024. When it started to break out, that's when, another bull market in gold began. If you're following this week, we broke through, and so far in September, same thing. We've talked about bonds rallying hard every trading day, essentially. That where we've been back since Labor Day. Gold has been very much the same thing. Gold is getting bid every day, it seems. And I think what I'd call out here is GDX, the gold miners. So Newmont being the only kind of representative in the S&P 500 index. The S&P 500 index is where all of the passive capital flows, right? And these are just buy decision, sell decision. They're not based on price. That's the definition of passive. Just if you give me money, then buy, or if I need to rebalance, then sell, right? You're not looking at value. So that passive capital going into the S&P 500, the only company that's getting any essentially lift from those flows so far is Newmont. Now, if you look at the GDX, VanEck Gold Miners ETF, this is actually the profitable gold miners who are, they have mines in active production. They have a real business. It's not, a junior play or a more speculative play. Hey, we have some geological reports that say like this looks like a mine can be built here, all of this, but it's not yet in production. Much more speculative. Those companies, which tend to be there are some wins in there if like you're a real professional here on the gold mining and development space. But for the most part, there's a lot of crap in there as well. So ignore those. The GDX is everything in terms of the miner or the mining industry that's actually producing, right? They've got gold ounces to sell. And at this point, I think in 2024, you saw, I've got the yellow lines here. You've got the upward trend, a strong up move, but I would say what we've seen in the last couple of months here, since essentially August, right? Since we turned into August, we've got the breakout above that upward line closest to the right. That is different than the breakout or than the upward trend of a bull wave, if you will, that we saw from 2019 to 2020. Why do I call this out? Well, 2019 is when we started seeing the rate cuts, right? We flipped over from a hiking cycle to an easing cycle at the July 29th, 2019 Fed meeting, right? That's when we started cutting, responded again in September. Repo market started to, spasm, and we had to put out that fire in September, October, and then we wait, and then we get COVID in March, and we just do the mother of all easings, right? Buy trillions of dollars in monetary support in terms of direct money printing from the Fed, absorbing that debt onto its own balance sheet, as well as cutting interest rates back to zero, returning to that zero lower bound. GDX didn't break out in that environment. What the market was saying is, hey, that $2,000 level where we hit in August of 2020, that's not for real here. We don't believe you. There was no market rally. Like it topped out essentially in the gold miners. What we've just seen since August, in my opinion, was that kind of acceptance from the market that these new gold prices, $3,000, $3,500, whatever, this new level, that's here to stay. And now your capital is coming in to the gold miners space who see that prospects of these levels of gold prices, this is here to stay, right? Is their interpretation, or at least for a term long enough for the miners to actually capture a decent portion of these value of this value at these higher gold prices in their financial statements or in their earnings. Um, so we're at an interesting point here for GDX, right? We're in that upward sloping line, the yellow, prior to, I think, the last 6 weeks, these gold miners had no ownership, right? It's just the same guys on backroom chats who are like the diehard believers in the space, right? They've been in it forever, their whole lives. It's like we just invest in gold miners, gold bugs, etc., because this is who we are. But there was no new capital coming in, right? And it was still it's just how market cycles work, right? At the bottoms or in the bear markets, like there's just no new investor interest, right? There's very little buying in the space. When things really catch on, the market signal shows up. You cross over that point where new investors start to come in. So I think what we're seeing with GDX, we've just started to break out both on the that yellow line, that upward sloping. We crossed over from that line being resistance. The higher highs were getting sold. Well, we've broken out above that, right? So that means new capital. That likely means what that's telling you is new capital is coming in. And generally what you see is on these key lines, resistance flips to support or, vice versa. But this trend, the bull market movement in gold, I mean, I don't see it as being finished by any means. It's proxying what we're seeing in the gold markets. It also just broke through that horizontal line, that all-time high set in 2011, where if everybody remembers kind of that phase, you had cash for gold advertisements on cable TV. You could not avoid them at any and every commercial break. And even to the point where, Super Bowl ads featuring MC Hammer wearing gold pants, gold everything, right? So that tells you where the public sentiment is at a top. I don't think we're even there yet, right? In terms of the gold kind of bull wave, right? We've seen Costco, right? You see these screenshots on your social media feeds every once in a while of Costco selling, ounces of gold at this point. Consumers buying it, and that's true. But even still, it doesn't hit me as it's not even frothy yet, and my sentiment kind of evaluation. And I'm very much not an expert on that, but it's kind of you know it when you see it. This does not feel like it's this trend is done yet. Same thing as that AI one we discussed in the last section. Those names in blue, they're telling you there's something very much there's a there. So both of these things, the blues, they're in the index, they're driving the S&P 500 up. But as you start to see if this continues in the GDX, and the profitability shows up in the earnings of these gold miners, well, I would expect some of these, like the best of breed within the ownership of GDX equity, as the equity indices go through their additions, removals, on their calendar reset. Some of these names will make it into the S&P 500, encouraging passive flows, investor capital coming into the space and pushing this bull trend towards the latter innings of a move. So something I'd watch out for. But I think when you're looking for signal, markets telling you where value creation is, right? It doesn't go up, it doesn't move linearly, right? Put a linear regression on to tell you slope, right? And then the waves, the volatility will move around those. But what we're seeing from Newmont within the S&P 500, as well as the gold market itself, as well as GDX, gold is just as much so one of these core trends going on as is the AI and I just call it a broader information technology new wave trend. I'm personally, this is just my thoughts here. I think we might need a better word to describe what's going on than just AI, because it is part of this information technology wave. which has been the entire growth of the US economy since like 1950, right? We've been riding this wave since World War II. It's just the next one in that. I don't know if AI is the right term for that or not, but I think it's much broader at this point in terms of what's going on with value and where people are deciding where subjective value lives in terms of the things they'll invest in. It's not just Nvidia, it's not just Mag 7 now. It's this whole big picture thing going on that right now we're loosely describing as AI. I think for lack of a better term at this point, let's call it that. But that's what's going on. So that and gold, keep watching. As everybody knows who's listened to me or Cameron in the past, we're also bullish on Bitcoin as a core trend. That one's taking a breather right now in August and September. That's wait and see mode. We'll have more on that one in the future. But for now, let's just leave it as those two core trends, and we'll call it a week.
Thank you everybody for tuning in. I think Matt wrapped up the episode well. So again, like and subscribe. We'd love to see comments, things like that. So give us any feedback you have. Hope everybody has a good week.
All right, take care. Hug your friends, family, and loved ones, as yesterday showed. Things can change on a dime. So live in the moment, go out, touch grass, and and enjoy life.